Hey, everybody, and welcome back to another deep dive. The world of investing can seem like a jungle sometimes, especially when you're first starting out.
Oh, absolutely. It's so easy to get lost in the jargon and the sheer amount of information out there.
Yeah, exactly. And you've been sharing some fascinating material with us about the most common mistakes that new investors often make, and I'm super curious to really dig into this stuff today.
Well, it's always a good idea to learn from other people's mistakes.
Right?
I mean, even for seasoned investors, it's helpful to kind of revisit these basic principles and make sure we're not falling into any bad habits.
So true. We've all heard those cautionary tales, right? Like the friend who got a hot stock tip and thought they were going to be, the next Warren Buffett or something.
Oh,
And
yeah.
then it all kind of came crashing down.
Oof. Yeah, a classic example of what not to do.
Yeah.
And it actually perfectly illustrates the first mistake that our source material highlights, which is diving into investing without a clear strategy.
It's like setting off on a road trip with no map and no destination in mind.
Exactly. And the source material actually uses that very analogy. They compare investing to a journey. And just like with any journey, you need to know where you're going before you can figure out how to get there.
Right. So before you even think about stocks or bonds or any of that, you need to define your financial goals.
Mm.
Like, what are you actually trying to achieve? Are you saving for a down payment? Are you aiming for early retirement? Or are you just trying to build a solid safety net?
Exactly. Those are your destinations. And once you have those destinations in mind, you can start to think about the best route to get there. That's where your investment strategy comes in.
Okay, this is where things start to get really interesting because our source material emphasizes that there's no one-size-fits-all approach to investing, right? Like a 20-something who's just starting their career would probably have a very different strategy than someone who's nearing retirement.
Oh, absolutely. Time horizon is a huge factor here. A younger investor might be more comfortable taking on more risk because they have more time to recover from potential losses.
So they might be more inclined to invest in those, high-growth stocks
Right.
that have the potential for big gains, but also come with more volatility.
Right,
Yeah.
exactly. While someone nearing retirement might prioritize preserving their capital and generating a steady income stream, so they might focus on less volatile assets like bonds or dividend-paying stocks.
Gotcha. That makes a lot of sense. So as we're going through these mistakes, I think it's super important for everyone listening to kind of keep their own time horizon and goals in mind. What's your destination, so to speak?
Great point. That will really help you evaluate which of these strategies and tips actually resonate with your individual situation.
All right, let's move on to mistake number 2. Trying to time the market. It sounds so tempting to buy low and sell high, but is it really possible to do that consistently?
Well, the allure of timing the market is definitely undeniable,
Oh.
right? I mean, who wouldn't want to perfectly predict those market swings and make a fortune? But in reality, it's incredibly difficult to do consistently, even for the most experienced professionals.
It's like trying to catch lightning in a bottle or something.
Exactly. And, the source material gives this great example from early 2020 when the pandemic first hit and the market crashed. Remember, some investors panicked and sold everything, locking in their losses.
Oh, I bet they regretted that decision when the market rebounded so quickly.
Many did. It just highlights how unpredictable those short-term market movements can be.
Right. So if trying to time the market is kind of a recipe for disaster, what's a more reliable alternative?
Well, the source material recommends a strategy called dollar cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of what the market is doing.
So instead of trying to guess the perfect time to buy or sell, you're basically just consistently investing over time, kind of riding out those inevitable ups and downs.
Exactly. And one of the biggest benefits of dollar cost averaging is that it takes the emotion out of investing. You're not making decisions based on fear or greed, but on a predetermined plan.
And as a bonus, by investing consistently, you're automatically buying more shares when prices are low and fewer shares when prices are high. It's like built-in bargain hunting.
Exactly. Over time, dollar cost averaging can really help lower your average cost per share, which can potentially boost your returns. It's a very popular strategy for retirement accounts because of its long-term focus.
That makes sense.
Yeah.
All right, let's move on to mistake number 3, neglecting diversification. Our source material uses that classic analogy of putting all your eggs in one basket.
It's such a simple but powerful image. If you drop that basket, you lose everything. The same principle applies to investing. If you concentrate all your investments in just one asset or one sector, your entire portfolio becomes vulnerable to any downturn in that area.
So let's say you're totally convinced that tech stocks are the future and you decide to put all your money into one hot tech company. What happens if that company faces some unexpected challenges?
Right, like a new competitor emerges or a product fails or there's some kind of scandal, suddenly your entire investment is at risk.
Yikes. That's a scary thought. So diversification is all about spreading your risk across different asset classes, like stocks, bonds, real estate, maybe even commodities. It's about not putting all your eggs in one basket, right?
Exactly. Think of it like building a well-balanced meal. You wouldn't just eat one type of food all the time.
Right.
You need a variety of nutrients to be healthy.
So a diversified portfolio is kind of like a healthy diet for your finances.
I like that analogy. And the source actually gives an example of a well-diversified portfolio. They suggest a mix of tech stocks, healthcare stocks, bonds, and maybe even a little real estate. So if one sector is struggling, others might be performing well, which helps balance out your overall returns.
That's great. But how can someone easily achieve that kind of diversification? I mean, without having to pick and choose dozens of individual investments.
That's where index funds and ETFs come in. They offer instant diversification because they track a basket of different assets.
Now, the source specifically mentions the S&P 500 index fund as an example. Can you tell us a little bit more about that?
Sure, the S&P 500 index fund tracks the performance of 500 of the largest publicly traded companies in the United States, so it covers a wide range of sectors and industries.
So by investing in a single S&P 500 index fund, you're instantly diversified across hundreds of companies.
Exactly. And for someone just starting out, index funds and ETFs can be a great way to build a diversified portfolio without needing to become a stock picking expert.
Awesome. So that leads us perfectly into mistake number 4, chasing past performance.
Ah, yes. The classic trap that so many investors fall into, especially when they're new to the game.
I know it's so tempting to look at a stock that's been skyrocketing and think, oh man, if only I had bought that a year ago.
Right. But, as our source material points out, past performance is not necessarily indicative of future returns. It can actually be quite misleading. Just because a stock has done well in the past doesn't mean it will continue to do so.
And they use the example of a hot tech stock to illustrate this point. Maybe that company's recent success was driven by a temporary surge in demand or a product that's now facing tough competition.
Exactly. Chasing past performance is like driving while only looking in your rearview mirror. You've got to focus on what's ahead, not on what's already happened.
Okay, so instead of getting caught up in the hype or the fear of missing out, what should investors be focusing on?
Well, the source suggests we shift our attention to a company's fundamentals. Look beyond the headlines and dig deeper into the company's financial health 7. Analyze their revenue growth, their profitability, their competitive advantage.
So is the company actually making money? Are they growing their customer base? Do they have a unique product or service that really sets them apart?
Those are the questions to ask. Investing based on solid fundamentals is like building a house on a strong foundation.
Much more likely to weather any storms, right? Now let's talk about a mistake that many investors might not even realize they're making: underestimating the impact of fees.
Ah, yes, fees can be sneaky. They quietly chip away at your returns over time, kind of like termites eating away at the foundation of your financial house.
And the source material actually does some pretty eye-opening calculations to show just how much those fees can erode your gains over the long term. Even seemingly small percentages can really add up over decades.
It's death by 1,000 cuts.
They give the example of a $10,000 investment that grows at 8% per year. But if you're paying 1% in fees, your actual return is reduced to 7%. It might not seem like a big difference at first, but over 30 years, it could cost you tens of thousands of dollars.
Exactly. So it's absolutely crucial to pay attention to those fees and seek out low-cost investment options. And, index funds and ETFs, which typically have very low expense ratios, can be a good place to start.
And if you're working with a financial advisor, it's important to understand their compensation structure as well. Are they charging a percentage of your assets under management, or hourly fees, or commissions? You really need to know how your advisor is getting paid so you can understand any potential conflicts of interest and make sure their recommendations are truly in your best interest.
Transparency is key.
Absolutely. The source also mentions robo-advisors as a potentially cost-effective option, especially for new investors. Can you tell us a little bit more about those?
Sure. Robo-advisors basically use algorithms to manage your investments, and they often charge lower fees than traditional human advisors. It's a more hands-off approach. which can be appealing for people who don't want to spend a lot of time managing their investments.
So while robo-advisors can be a good option, especially for beginners who are trying to keep costs down, it's still essential to understand how their fees work and what services they provide.
Absolutely. No matter who or what is managing your money, you always need to be informed about the fees involved.
Okay, let's move on to mistake number 6. Letting emotions drive your investment decisions.
Oh boy. The emotional roller coaster of the market can be quite a ride, and if you let your emotions take over, it can lead to some pretty costly mistakes.
Yeah, our source material uses the 2008 financial crisis as an example. Remember the widespread fear and panic during that time?
Oh yeah. So many investors were overwhelmed by their emotions and they made really impulsive decisions. They sold their holdings at the worst possible time, locking in massive losses.
And then, of course, the market eventually recovered.
Exactly. It just goes to show that it's so important to have a long-term perspective when it comes to investing. The market is cyclical. It will always have its ups and downs. But historically speaking, the stock market has trended upwards over time.
So how can investors avoid making those impulsive, emotion-driven decisions during those inevitable market swings?
Well, the source suggests that it's really helpful to establish some clear rules or guidelines for yourself in advance. For example, decide how much of a market drop you're willing to tolerate before making any changes to your portfolio.
Okay. So having those predetermined rules can help you stay calm and avoid making rash decisions based on fear.
Exactly. It's like having a safety net for your emotions.
I like that. All right, let's move on to the final common mistake outlined in the source material. And this one actually applies to so many areas of life, not just investing.
I think I know where you're going with this. Not educating yourself enough.
You got it. You know, the source really emphasizes the importance of going beyond just those hot stock tips and surface level advice. It's about really understanding those underlying principles of finance and economics and risk management. It's about becoming a lifelong learner, constantly seeking out knowledge and refining your understanding of how markets work.
So true. And there are so many resources available these days: books, tutorials, online courses, and of course, podcasts like this one.
Exactly. And the key is to tailor your education to your specific interests and goals. So if you're really passionate about real estate investing, for example, dive deep into that world. Learn everything you can. If you're curious about bonds, go all in on bonds.
Exactly. Be curious, ask questions. Don't be afraid to admit what you don't know.
You know, there's no such thing as a stupid question when it comes to investing. We all start somewhere.
The more questions you ask, the more you'll learn.
All right, so there you have it.
Hmm.
We've now covered those 7 common mistakes outlined in our source material. And wow, what a great discussion so far.
This is great.
We're going to take a quick break, and we'll be right back to delve a little deeper and wrap things up. Don't go anywhere.
Welcome back. You know, as we've been talking about these common investing mistakes, I've been thinking about something that doesn't always get enough attention.
Oh, yeah. What's that?
The power of mindset.
Mindset.
Yeah. You know, our beliefs about money and investing can really have a huge impact on the decisions we make.
Okay, I see what you mean. So if you approach investing with a lot of fear and anxiety, always worrying about losing money, you're more likely to make impulsive choices that could actually hurt you in the long run.
Exactly. Fear can either lead to paralysis where you're too afraid to do anything, or it can lead to panic selling, where you just dump all your investments at the first sign of trouble and lock in those losses.
Right. And on the flip side, if you're driven by greed, always chasing those hot stocks or get-rich-quick schemes, you're probably more likely to make rash decisions without doing your due diligence.
Absolutely. Greed can really cloud our judgment. It can lead us to ignore those red flags or take on more risk than we can actually handle. It's important to remember that building wealth sustainably is usually a slow and steady process.
Okay, so what's the antidote to all of this? Like, what kind of mindset can help us approach investing with more, clarity and confidence?
Well, the source material doesn't explicitly talk about mindset, but if we connect the dots, I think it's pretty clear that cultivating a patient, disciplined, long-term approach is key.
So it's about shifting our focus from those short-term gains to really building wealth over time, understanding that there will be ups and downs along the way.
Exactly. And one of the most important mindset shifts is embracing the idea that time and the market is more important than timing the market.
Oh, yeah. That goes back to what we were talking about earlier. Trying to predict those market movements is incredibly difficult, even for the experts.
So true. So instead of trying to outsmart the market, we can use strategies like dollar cost averaging, investing consistently over time and riding out those fluctuations. That way we can actually benefit from the long-term upward trend of the market.
Okay. Now, this makes me think about another important aspect of mindset. Embracing a growth mentality.
Ah, yes. A growth mindset is so important in investing because it's all about believing that you can learn and improve even if you're starting from scratch.
Yeah, it's about viewing challenges as opportunities for growth rather than setbacks, which I think is so crucial when it comes to investing. Because we're all going to make mistakes at some point.
Right, absolutely. We all start somewhere.
Yeah.
And, the path to becoming a successful investor is definitely paved with wins and losses. The key is to learn from those experiences and just continually refine your approach.
So instead of beating yourself up over a bad investment decision, ask yourself, what could I have done differently? What can I learn from this?
Exactly. Even the most successful investors in the world have made mistakes. The difference is they've learned from those mistakes and they've used those experiences to grow and improve.
So how can we actively cultivate this growth mindset when it comes to investing?
Well, I think there are a few key things we can do. And this is kind of taking the source material a step further. But first, surround yourself with positive influences. You know, seek out mentors, join online communities, listen to podcasts like this one that promote a growth-oriented approach to investing.
It's all about finding your tribe,
Yeah.
connecting with like-minded people who can support you and inspire you on your journey.
Exactly. And second, be relentlessly curious. Ask questions. Don't be afraid to admit what you don't know.
We all have to start somewhere, and there are no stupid questions when it comes to investing.
Couldn't agree more. The more questions you ask, the more you'll learn. Third, celebrate your wins, even the small ones. Did you finally open that investment account you've been putting off? Did you read a book about investing? Did you learn a new concept? Give yourself credit for those milestones.
I love that. Acknowledging those small victories can keep you motivated and build momentum.
So true. And finally, and perhaps most importantly, be patient. Investing is a marathon, not a sprint. It takes time to learn and grow and see those compounding returns really kick in.
Right. Don't get discouraged if you don't become a millionaire overnight. Focus on building that solid foundation, making consistent progress,
Yeah.
and enjoying the process.
Now let's connect this back to those common mistakes we were discussing earlier.
Okay, yeah. Let's see how a growth mindset can actually help us avoid some of those pitfalls.
For instance, remember that mistake of chasing past performance? A growth mindset encourages us to look beyond those short-term gains and focus on those long-term fundamentals.
It's about understanding that sustainable growth takes time and that there will be inevitable ups and downs along the way.
Exactly. And think about that mistake of letting our emotions drive our decisions. A growth mindset can really help us stay calm and rational during those periods of market volatility. Instead of panicking and selling when the market takes a dip, we can view those dips as potential buying opportunities.
It's about having that confidence to stick to your long-term plan, knowing that the market has historically recovered from those downturns.
Right. And finally, there's the mistake of not educating yourself enough. A growth mindset is all about continuous learning and improvement.
It's about embracing the fact that we'll never know everything, and that's okay.
The world of investing is constantly changing, so a willingness to learn and adapt is essential for long-term success.
This conversation has been so insightful. I feel like we've gone beyond just scratching the surface of those mistakes and really dug into those deeper principles that can guide us on our investing journeys.
I agree. It's been great to not only explore what to avoid, but also to understand why those mistakes happen and how developing a growth mindset can help us make more informed and empowered decisions.
So as we wrap up this deep dive into common investing mistakes, what's the key takeaway you want our listeners to walk away with?
If we think about the big picture, I think the most important takeaway is this. Investing isn't just about numbers and strategies. It's about aligning your finances with your values and goals.
I love that. It's about figuring out what really matters to you and then using your investments as a tool to help you achieve those dreams.
Exactly. Whether it's saving for a down payment on a house, funding your children's education, or even creating a more sustainable future, your investments can be a powerful force for good.
Okay, so as you embark on your investing journey, remember to stay curious, keep learning, and never be afraid to ask questions.
It's your journey. Embrace it, own it, and make it work for you.
That is such a great note to end on. Thanks for joining us on this deep dive into common investing mistakes. We hope you've gained some valuable insights and feel empowered to take control of your financial future.
Until next time, keep exploring, keep learning, and keep investing in yourself.
As we wrap up this deep dive, I can't help but notice how interconnected all these mistakes seem to be.
Yeah, I see what you mean. Like it's all part of a bigger picture.
Right. For instance, if you don't take the time to really educate yourself about investing, you're probably more likely to fall into those traps of chasing past performance or trying to time the market.
Absolutely. And if you let fear or greed drive your decisions, you're probably more likely to make those mistakes with diversification or understanding those
It's
fees.
like a vicious cycle. But the good news is by understanding these mistakes and really cultivating that growth mindset, we can break free.
Exactly. Knowledge is power. The more we understand about investing, the better equipped we are to make those good decisions and avoid those pitfalls.
So as we wrap up today, what's that one final thought you want to leave our listeners with?
You know, when we connect this back to the source material, I think the biggest takeaway is investing isn't just about numbers and strategies. It's about aligning your finances with your values and your goals. Oh, I love that. It's about figuring out what truly matters to you and then using your investments to help you achieve those aspirations.
Right. Whether it's saving for your dream home or funding your children's education or even, creating a more sustainable future, your investments can be a powerful force for good.
So as you embark on your investing journey, remember to stay curious, keep learning, and never hesitate to ask questions.
And remember, it's your journey. Embrace it, own it, and make it work for you.
That is a fantastic note to end on. Thanks for joining us on this deep dive into those common investing mistakes. We hope you've learned some valuable insights today and feel empowered to really take control of your financial future.
Until next time, keep exploring, keep learning, and keep investing in yourself.